Good afternoon, everybody, and welcome to the Wednesday Lunchtime Drive-Through on Wednesday, August the 17th, 2022. I'm your host, Damon King. I'll be serving up today's topic, should you consider a Roth conversion in 2022? I'm the lead instructor for ChappelWood University, which is the educational branch of our wealth management firm, ChappelWood Financial Services. I'm also a certified financial planner and an investment advisor and wealth management advisor. And the purpose of these short little webinars every week is to keep you abreast of current events, as well as just new strategies, maybe things you hadn't thought about. Now, Roth conversions aren't exactly a new strategy. I've talked to many of our clients about this, and I've taught pretty extensively in my Rock Your Retirement course and other classes that I've taught about Roth conversions, but it bears repeating, and I like to remind you from time to time, because there is a window of time that is getting smaller and smaller as the years go by to enjoy a better environment for making Roth conversions. So we're going to talk about what is a conversion and why now might be a good time to consider a conversion. As always, if you've got a question or comment, please put it down in the comment section using the chat or the Q&A function. Should be down in the little toolbar that you see down below. Just hover over that and you can submit your question or comment. So let's get into it, shall we? Oh, there we go. So what is a Roth conversion? Let's start with the basics first. So you have heard there's a traditional IRA and there's a Roth IRA. Both of the IRAs are very similar. They're almost identical in what they do. You can invest in the exact same assets, stocks over here, mutual funds over here, mutual funds over here. The key difference is, how does the IRS view them for tax purposes? That's the key difference between them, is their tax status. A traditional IRA is a tax deferred vehicle. You make contributions to that, you get to claim a tax deduction above the line. So it's an above the line deduction that everyone can qualify for if you're eligible to contribute to a traditional IRA. When you take that tax deduction, basically you are telling Uncle Sam, you know what? I don't want to pay the tax today. Let's let the account grow, and I won't pay taxes on any of the gains or income until I start pulling money out sometime far in the future. The Roth IRA is exactly the opposite. You tell Uncle Sam, you know what? I'd like to go ahead and pay the tax now. I'm not going to take the deduction. But in exchange, what I'd like is many years of growth that later on, when I pull the money out, will be tax-free. Our tax code is actually pretty simple when you think about it. I mean, there's many, many pages of it and get very detailed. But the basics of our tax code are this. You can either pay the tax now or you can pay it later. And depending on which route you go, the opposite will be true at the end. If you pay tax now, you won't pay it later. If you don't pay tax now, you're going to pay it later. Eventually, you're going to pay. And now they're hiring a whole bunch more IRS agents just to make sure that you do that very thing, right? I was going to actually talk about the Inflation Reduction Act, but I didn't have as much time to get into the details of that. And I will do a future episode on that. But I wanted to make sure that I had time to get my stuff in order. So anyway, when you do a Roth conversion, you are essentially transferring or converting a sum of money from a traditional IRA to a Roth IRA. So you're taking that money that is pre-tax in the traditional and you're converting it into tax-free money. Now, the catch is this. It passes through the tax window. It goes from pre-tax to now after tax. Someone has to pay that tax. It has to come, you're going to pay the tax, but it's got to come from somewhere. That converted amount from traditional to Roth is considered a taxable distribution to you. You will receive a 1099 at the end of the year or just prior to the next tax filing deadline, showing that you received this money, even though you didn't actually receive it. It's sitting in your Roth IRA. It did not go to your bank account, but for purposes of claiming it on your tax return, it's reported as taxable income. And you have to pay the tax yourself. You cannot withhold the tax from the converted amount. So if you're going to convert $50,000 $50,000 must show up in the Roth IRA. You can't withhold the tax from the conversion, and now 30,000 shows up. All right. So how do you pay the tax? You're going to pay for it with cash out of your pocket. All right. That's how you're going to pay it. The next question I get a lot, are there limitations on a Roth conversion? Because there are limitations on how much you can add to any IRA or to a Roth IRA, especially based on your income. But when it comes to conversion, there is no income limitation. The IRS imposes no income limitation on conversion of money. If you want to convert $10 million from traditional to Roth, you can do it. You're going to pay tax on all that, but you can do it. There are, as I said, income limitations on adding new funds or making a contribution. So we want to get our terminology right. A contribution is new money that you're adding. It's not been in any of your investment accounts. There is an income limitation on putting money into a Roth, new money. Conversion is simply taking money that already exists in an investment account, an IRA, and simply moving it over. So the income limitations on adding new funds to a Roth IRA are if you file a single tax return, if you make greater than $144,000, or on a joint tax return, if you make greater than $214,000, you are completely phased out from contributing to a Roth IRA. Now, the phase out actually begins $10,000 less. So, for example, it's a range from, if you file a single tax return, $134,000 to $144,000. If you make $134,000 and anything in between up to $144,000, you're going to be phased out, and you're able to contribute 10% less for each $1,000 above $134,000 that you earned. All right. So if you're below $134,000, you can put the max contribution into a Roth. But if you're $135,000, you can put 90% of the amount. If you're at $136,000, you can put 80%, so on and so forth, all the way until you get to $144,000 and above. And now you can't contribute at all. And it's the same thing for a joint. There's a range from $204,000 to $214,000, and your ability to contribute to a Roth is reduced by 10% for every $1,000 you earn above that lower threshold, up to a cap of $214,000. The other thing, you have to have earned income. You cannot add any new money to an IRA unless you have earned income. You do not have to have earned income to do a conversion. So again, there are limitations on adding new money to an IRA. Those limitations don't exist when you are looking at a conversion. So if you're a high income earner and you're the prime of your career, your prime earning years, conversion may be the only way that you can get money into a Roth IRA. Either if you're not earning enough or earning any, or if you're earning too much. So it's income related. And if you're not earning any, or if you're earning too much, conversion may be the only way that you can get money into a Roth IRA. Now, there is another strategy called a backdoor Roth conversion. I'm not going to get into that today, but if you'd like to have a conversation about that, I'm happy to talk with you. But there is a way for wealthier people, higher income earners, to get money into a Roth. It's a little convoluted and complicated, and it's a loophole, and Congress is looking at closing it. All right, so now to the crux of the whole reason we're here today. Why might conversion from traditional to Roth be a good idea right now? The biggest reason that Roth conversions are attractive right now is because the income tax rates are lower now than they will be starting in the year 2026. So if you'll recall, there was a bill signed into law by President Trump in 2017 called the Tax Cuts and Jobs Act, and it went into effect January 1 of 2018. That act did a couple of things. Number one, it lowered tax rates for 5 out of the 7 tax brackets. So most tax brackets saw a reduction in their tax rate by 2, maybe 3% in some cases. All right, so it's not a lot, but it is a reduction. The other thing it did was, in some cases, it widened the actual income brackets. So you could earn more income inside of certain brackets, meaning that it's less likely that you get bumped up into a higher tax bracket. But the real benefit was it lowered the tax rates, but not permanently. It's going to sunset, and that sunset is from 2018 through December 31 of 2025. Starting with tax year 2026, the tax rates go back up to what they were previously. You're going to eventually have to pay tax on your, so if you've got a big traditional IRA, you will eventually pay tax on that money. Uncle Sam cannot be put off forever. Now, right now, the point of no return is the age of 72. So starting at age 72, if you have not already started taking required minimum distributions, or RMDs, that age is 72. If you've already started taking your RMDs, well, then you have to keep taking them. The old age was 70 and a half. But the Secure Act, which was a totally different law that was passed in 2019, raised the RMD age from 70 and a half to 72. There is actually a new proposal, the Secure Act 2.0, that is making its way through Congress right now, that proposes to raise the RMD age even higher, to age 75. So not only are the tax rates lower right now, that's one reason why the conversion might be a good idea, but now you also have, because the RMD age is higher, you've got a longer period of time to make your conversions before you have to start taking money out of your traditional IRAs. Here's another reason why conversion might be a good idea right now. The market's down. Now, over the last 45 days, the market is up about 11%, a little over 11%. Okay. So it's gained back about half of what it lost for the year, which means if you took a look at your June statements, they were horrifying. But your July and August statements should look a lot better because the market's been up. Still, you're probably, if you are moderate to aggressive in your investments, you probably have some segments of your portfolio that are still down. Now, if you're going to convert money, remember, the more you convert, the more tax you're going to pay, right? A lot of people like to go ahead and convert when the market's down, because now you can convert the same assets, but at a lower price. So your conversion will cost less when the market is down. In some ways, it's a lot like tax loss harvesting. If you've got a taxable after-tax account, one way to minimize taxes, capital gains, is offset those gains by selling losers. Capital losses can offset capital gains. Well, selling or converting from your traditional IRA to a Roth when the market is down effectively lowers the cost of the conversion, because you're converting the same assets, but at a lower price, at a lower value. So, a few reasons, but the question I always ask people is, when would you rather pay the tax? Now, while the rates are lower, or later when you know they're going to be higher? It's a pretty simple question to answer, right? It's not the only consideration, but that's why I'm a big fan of Roth conversions right now, because the tax rates are lower, and including 2022, and you have to have the conversion done by December 31 of the tax year. So this isn't like you have until April 15th to add money to your IRA for last year. If you're going to do a conversion and you want it counted against that year's taxes, it must be done within the calendar year. But you have 22, 23, 24, and 25. You have 4 more tax seasons, including this one, to take advantage of the lower tax rates. Now, there are some other reasons why Roth money is awesome. Okay, so one thing is, if you convert now, you're going to pay tax at a lower rate than you will in starting just a few more years. But there are other reasons to build in a nice bucket of Roth money for yourself that will become apparent later on in life. Number one, Roth IRAs are not subject to required minimum distributions. Traditional IRAs are. Roth IRAs are not. So starting at age 72, Uncle Sam is not going to tell you to start taking money out of your accounts if you don't want to. And the reason for that is very simple, right? With a traditional IRA, Uncle Sam has not gotten his haircut. He wants it. And 72 is the longest he's going to wait for it. But with a Roth IRA, you've already paid Uncle Sam. So he doesn't care when you take it. Later on, when you do take the money out, though, those distributions are tax-free under current law. I always have to add that in. Okay. Congress can always change the laws. But the other superpower of a Roth, and this is one of my favorites, Roth distributions are tax-free, and as such, they are not counted as part of your adjusted gross income. It is your adjusted gross income. The higher your AGI is, the more of your Social Security that can be taxed. The higher your adjusted gross income, the higher your Medicare premiums for Part A, B, and D can be. Roth distributions do not count towards any of that. As a result, theoretically, in retirement, if all you had was Social Security and Roth IRAs, you would pay virtually zero tax because, first of all, the Roth is completely tax-free, and the formula for taxing Social Security is built so that the likelihood that you would have enough taxable income to get above the thresholds is pretty remote. So you want to create a tax-free retirement for yourself? I call it the holy grail of income planning. Set up your retirement so that you've only got Social Security and Roth distributions. You would pay virtually zero tax on those monies. Now, if you then took your Roth money and invested it in something else later, like a joint account and dividends and capital gains, that might be taxed. But anyway, Roths can help to lower your taxes and certain costs at a time when you can least afford to pay them, when you've given up a dedicated paycheck, also known as retirement. When can you least afford to pay for stuff? When you're not 100% sure that your paycheck is guaranteed. Now, if you've saved up enough money and you've got an income plan, pretty good chance the money's going to keep coming. But those of you who are retired, and certainly just recently retired, you understand what I'm talking about, right? There's a mentally, psychologically, there's a big difference. That transition from I got paid every 2 weeks or every month by my employer to when is my money going to come in? And if it doesn't show up on time, I'm on the phone to my advisor saying, hey, where's my money? Right? So trying to lower your taxes in retirement is a good thing. Good thing. So the next obvious question that I get is, all right, well, then how much should I convert? How do I decide how much to convert? And there are really two ways to approach this question. The first way is, how much more taxable income can you report to the IRS on your tax return without bumping you into the next tax bracket? So if you could claim if you could report an extra $50,000 in income without going into the next tax bracket, then that's how much you would convert. Convert just enough to keep you at the top end of the lower tax bracket. And there you go. Now, that's how much you can convert without going into another tax bracket. But remember, the conversion, the tax, has to come out of your pocket. It's probably going to come from your cash, either in your checking or savings account, or maybe you pull it from another after-tax investment account. But the point is, you have to pay the tax out of your pocket. A more practical way, I believe, to address this issue is, how much additional tax am I willing to pay? Based upon my available buckets of money, cash and otherwise, how much of that am I willing to part with to pay additional tax? And then based on that and my tax rate, I'll work with my CPA, my tax preparer, to back into how much I should convert. Because just because I can convert $50,000 and avoid going into the next tax bracket does not necessarily mean that I've got the cash on hand to pay that much tax, right? So I believe from a practical standpoint and from a budgeting standpoint and the way that people actually manage their money and use their money, I believe that approach 2, the cash on hand approach, probably the most practical one to determine how much your conversion can be. Another approach, let's say you are 62 years old right now. Okay, so you're 10 years away from having to take required minimum distributions at 72, maybe 75 later if that new law passes. You've got a 10-year window here before you must start taking money from your traditional IRAs. Even after the tax rates go back up, you've got this long window to build a tax budget for yourself and to say, okay, I'm going to take my bucket of money here, my IRA, my traditional IRA, and I'm going to split it up into 10 equal installments. And I'm going to figure out how much tax am I willing to pay extra each of those 10 years before RMDs start. And then that's how much I'm going to convert each year. And you just set it up as another line item in your budget. If it's $10,000, $15,000, that's my cost for conversion. And you budget that. You call it a tax budget. Pretty simple, right? And I have many clients that that's what we do for them, or that's what we figured out. And now every year, usually around October or so, we'll process the conversion, confirm this is how much we want to do, and then we move on with life. So what questions do you have? Well, what thoughts do you have about Roth conversions? Have you ever done a Roth conversion? Some of you, I know you have, because we've helped you do it. Those of us that are clients. But is there anybody else that is thinking about a Roth conversion? Or you have more questions about a Roth conversion? Any questions at all? And while we're waiting for people to submit any questions or thoughts, I've got some other great clients that I want to say hello to. Well, I'm just going to run through the clients again, okay? So all my clients always get a shout out on the drive-through. So I want to say hi to Becky, Doug, Forrest, Jay, Kathy, other Kathy. So I've got Kathy in Oklahoma, and I've got Kathy down in Texas. Lynn, it's good to see you. I've got my Lynn in Oklahoma, and I've got my Lynn up in Missouri. So it's good to see both of you. Mary Sue, it's great to see you checking in from the windy city of Chicago. We've got Susie, it's good to see you, and Bill, it's good to see you too. And we do have a question here. Oh, Jennifer's there with, okay, Doug, I'm sorry, Jennifer, I'm sorry. I should have said Doug and Jennifer, right? So Jennifer, it's good to see you. I hope the new job is going well. We need to catch up soon. I'd love to hear about that. Okay, Lynn says, I think I should convert some money. You convinced me. I'm a very convincing guy, I have to admit. I mean, look at this charming face. But yeah, Lynn, let's get together. It's been a while since we've seen each other. We saw each other back at the beginning of the year, right? So we need to get together and talk about what that might look like in terms of a conversion for you. Absolutely. And you're young enough that we have a nice lead time to get that done. Bill says, can you use RMDs to pay taxes on a Roth conversion? You can certainly, Bill, when you take your RMD. So generally I advise withhold the taxes first, okay? Then whatever is remaining, you're just going to probably stick it inside of your savings account, right? Maybe you might reinvest it, but if you just take the resulting money after you pay the taxes on the RMD and stick it in the bank, if you don't need that money, and I know, Bill, that you guys have other streams of income, and if you don't really need that money, then yeah, you can take the resulting cash and now set that aside, reserve it as my escrow for taxes, and now I'm going to go out and convert even more money from my traditional to my Roth and use the leftover of the RMD to pay those taxes. Absolutely, you can do that. So that's a great question. Kathy, she says, LOL. Oh, she must have been laughing at my face comment there. Oh, you know what, Lynn? It was in May. See, I was thinking it was February that we saw each other. It was just May, right? May seems like forever ago to me. I don't know why. It just seems like, but you're right. Your kids were here. That's right. So we'll get together again in October. Okay, so that'll be our next strategy review time for all of my clients. On October is going to be our next time for strategy meetings, and you'll get an email to sign up for those. Of course, if you've got questions or things that come up before then, we can certainly discuss those. So great questions. So clearly, Lynn, we're going to add Roth conversion to your agenda when you come in October. Kathy, Bill, great question. Eddie, When is a good time to begin considering a Roth conversion, before or after retirement, before or after 59 and a half, or is it unique for each person based on their situation? Bingo. There, you nailed it. Eddie, you know me well enough that if you ask a question like that, the answer is going to be, it depends, right? It always depends. So I would want to sit down with you, because really, right now is a good time because the tax rates are lower, right? But maybe there's some other reasons. Just because the tax rates are lower, maybe you don't have enough cash on hand to make the payment. Maybe you can't do that. Maybe you're trying to pump all your money into paying down your mortgage. Okay, well, if that's the case, then I don't want to sacrifice your cash position for the sake of doing a conversion and paying down on your house. I will say this, ideally, I would want to try to convert as much money as I can before retirement, because again, while you're working, you've got a dedicated paycheck and your cash flow is more consistent and predictable at that point. As a result, it's going to be easier to budget paying those additional taxes on a conversion. Once you retire, well, yeah, your income will be consistent once we put together an income plan. You've got Social Security and things like that, but still, no one's coming to your rescue in retirement, right? I mean, ultimately, you're kind of on your own. You got an advisor, but you get what I'm saying. There's nobody putting money in your pocket anymore. You're putting your own money in your own pocket. So I would generally say I'd like to see the conversions before retirement, but we can still look at them after retirement, and I do for many of my clients. All right, we still have just a few minutes left here, about 3 more minutes. Really great questions. Any other questions for today on Roth conversions? Okay, Eddie has another question. Oh, wait a second, let's do this. Kathy says, can you open a Roth IRA with contributions from a rollover IRA? Yes, you can. So essentially, Kathy, if you don't already have a Roth IRA, all right, and you wanted to open a Roth IRA, you could actually open the Roth IRA with a conversion. All right, so if you're going to be using a rollover IRA or a traditional IRA, that's what that is. If you were to open a Roth IRA by using the money from the traditional, effectively what you're doing is a conversion, and you're simply using the conversion to open the new Roth account. So yeah, that is absolutely true, but just remember, it's still going to count as taxable income to you in that year that you do that. Let's see here. I had some other questions here. I got to get down to them. Eddie has another question, follow up. Is it even possible to convert TSP funds to Roth TSP funds while still an active federal employee? That's a good question, Eddie. I want to say yes, you can. However, I would want to take a look at the TSP rules, the TSP plan document, to verify that they would allow that. I mean, I don't see why not. But we would just need to check the rules there. But that's a good question. I'm not 100% certain on that answer, so we would need to check that. And if you've already got some paperwork on hand, or if you can contact the HR department or whatever, but give me a call and send me an email to remind me, and I can research it for you and see if we could do conversion from the traditional TSP side. And TSP, for those of you who don't know, Thrift Savings Plan, that's the 401k of the federal employee. Move it over to Roth. But that's a good idea. And here's something else that's kind of interesting. With the new bill that's going through, the Secure Act 2.0 that I told you about earlier, the focus of the Secure Act 2.0 is really on 401k participation. So the first Secure Act was about changing the rules and around when people had to take their money out, basically people who were already retired. So the Secure Act, the original one, addressed rules for people who are already retired, as well as inherited IRA rules. The Secure Act 2.0 is built more for those who are still working and who are still contributing to their 401k. So they want to expand the number of people that are participating in a 401k. But one of the interesting changes that the Secure Act 2.0 is looking to make is giving you the ability to tell your employer when they give you your match in your 401k or your 403b or your TSP, asking your employer to put the match into the Roth side. Right now, if you have a traditional and Roth option, if you choose the Roth 401k to defer your income, your employer is always making their match on the traditional side. Okay, that's the side that they're putting it on. But this new rule would allow you to ask your employer to please make my match on the Roth side. Now, I'm kind of curious how that's going to work out, because one of the benefits of the employer of putting it on the traditional side is they get to take a tax deduction on their corporate tax return for that. I'm kind of curious, pardon me. I'm kind of curious how that would work out if they were contributing to the Roth side. And there may be like an opt-out. I don't know what's going to happen on that. So everything's still in flux. So, all right. Well, it is now just after 1 o'clock. So I want to say thank you to all of you for joining us today on the Wednesday lunchtime drive-through. I hope you enjoyed today's topic. If you would like to discuss Roth conversion, certainly if you're one of our clients, but even if you're not, and you'd like to talk through what would a Roth conversion look like for you, just give me a call. I'm at 405-348-0909. You can also email me at Damon, D-A-M-O-N, at ChappelWood, that's ChappelWood.com. And I'm happy to answer any question that you have. So thank you again so much. Hope that you all stay safe today, stay prosperous, stay kind to one another. Becky, you're very welcome. Thank you for being here. And, life is too short to watch the news all day and get depressed. So my advice to you today, go outside, or if it's too hot, go do something fun. Don't sit at home and watch TV. It's depressing. Go outside, get some sunshine, go have some fun, go hit some golf balls, go to the lake and fish, or just go for a walk. Do something fun and productive, because there's enough bad news in the world. You don't need to bathe yourself in it. All right. That's my pep talk for the day. We'll see you next time on the Wednesday lunchtime drive-through. Bye-bye.